Hello everyone, this is Juan Sarmiento and today is Friday, August the 18th. Okay, the quickest thing we could do is to look at our current positions and see which one is due to expire, or you can simply open the trade here and see if they have an expiration, okay? Or simply click on the side here on the watch list, organize them alphabetically, and see if they have an expiring option. Okay, you can just look at it from this way. Okay, so you can see that there is a difference between the current value and the expiration value. The blue line or cyan line is what happens when the option expires if the stock price remains the same. So here you can see that it wouldn't be advantageous for us to do anything about it. We just sit here and wait. Look at the position from the original trade, and we have updated with every rollover, with every change that we have made, meaning closing call and open a new one later, we have adjusted our price. So you can see, for example, this stock APA has been sitting there producing great results so far. If it falls below this bend line here, that is where our profits begin to be cut a little bit. But again, because the price of the stock you expect to go up and down, it doesn't matter. What matters is that every week we roll over our shares, our options, so we sell the new ones that sell, brings us new extrinsic value. So let's go through them, okay, and quickly see where am I here. September the 8th, there's a long time before that option expires. But if you see it clearly, here, put your cursor here so you can see, okay, 6,000 versus 6,072. Okay, so there's $279 of extrinsic value waiting to be reduced. So I don't really have to do anything, but get closer, would you? Get closer by doing this action, and then you can see the difference, okay? Better. So I'm not going to change this. We have until September the 8th to see it works. But if the lines converge, become closer to each other, then it is worth to closing the option you have, which would have zero extrinsic value, and sell something else. Let's just go to the Add Simulated Trades, look at the option here, the expiration, scroll down, and you would see that there is lots of extrinsic value in that option. Even though it's way out of the money, there is still $1 full of extrinsic value. If this was zero or closer to zero, we could then sell another option with 30 days to go with more extrinsic value. Let me just demonstrate with ETSY, which is a stock that has been going down, and the difference is 557 versus 609, sorry. Let's go to the Add Simulated Trades and see what is our option extrinsic value. That option that we sold remain in value, and it says 53 cents. That's a lot of money, okay, theoretically speaking. And so we just let it come down closer to zero, and then we do the rollover. So for now, we don't do anything about that one. Let's move on to FL, Foot Locker. And here, see how much extrinsic value. The difference is between 100 and 1,000. So now, let's just, here it's better, that's better. The difference is about 500 really, okay? You can see the trade when adjusted for everything. It's about the same. This is probably because it's original trade, okay? There hasn't been any rollovers, and this is expiring next week. So next week we'll take a second look, and presumably these two lines will be more converging, which means the extrinsic value will be lower. Let's go to KSS. Okay, again, let's do the original trade. And okay, there is a lot of difference between the blue line and the pink line, which means there is a lot of extrinsic value and still to extinguish itself. Right here is $1.70. So we want that to go to zero or close to zero. So we just sit here and wait. But that's looking really good actually as a trade. So far, this is what it would look like. Let me see. That's not it. It hasn't been adjusted. So you can always go to the Monitor tab, Account Statement, enter the symbol here and say, let's go back, I don't know, 100 days. That's a whole lot more than we need. Okay, and you can see the prices here. You see, 3 times we had the original trade and we did a rollover and a rollover. So now we need a calculator, right? Just to make it very clear. Our original cost was $22.15. Then we did a rollover here and we got a credit of 31. That's a subtraction. So we said minus 0.31. That's our new cost. And then here it says a debit. That means that the stock went up from 24 to 28 and I adjusted my call higher. Okay, so we have to add $1.54. So we are going to add 1.54. And that's 23. That's my new cost. Then we can go to the Analyze tab. Now I have a cost here. I can simply say Analyze Closing, Cover Stock, and then Analyze Opposite. Okay, and now I just paste the price I calculated here. Paste. And it's $23, not $26. Okay, you can simply see it this way and I say, oh, okay, that's fantastic. I have a profit of $1,848. Okay, and no, I'm sorry, my current profit is $1,140, but I could make 18. So we just sit there tight and wait for that to occur. Okay, so September the 8th is the expiration. There's plenty of time for that pink line to approach the blue line. Let's go to MOS. In this case, that expires next week. Again, there is a difference. There's a pink line. Okay, you can simply show me this. Okay, and we say, okay, the difference still more than $100. So we are going to sit tight and wait that to the extrinsic value to erode. Let's go to MU. And this one didn't work out at first, right? Do you remember? This one, the stock went down and the volatility has dropped, and we have been trying to make up. Let's go to the Monitor tab. Okay, we've been trying to make up for the decline, too quick the decline in volatility, and the stock was going down and it didn't work out very well. But it doesn't matter because you can recover that money. If you want to bother, perhaps you want to just close the position and go elsewhere. Look at the year to date, that's $90. So we've recovered somewhat. Okay, let me just show you. Calculator again. Oops, let's go. Let's go to the Monitor tab. Okay, account statement. Okay, so again, the calculator. We started with $64.87 as our original cost. Then we got a credit by selling a single call here. Obviously, the original expired, and so we are going to subtract $2.25, and then this is a credit, so we're going to subtract 25 cents. Oops. Let me just repeat that. 64.87 minus 2.25 minus 0.25. Okay, that's the new price. I'm gonna say, go to the Analyze tab. We can adjust here. We got September the 15th. And my price is, the strike price is 65. And I'm just gonna paste my new price here. and it's a little bit more, just a difference of cents, literally. So let's hide that simulation. Let's hide the position and show just the simulation, because that's my adjusted price. And look at this. We have recovered most of the, we have pretty well recovered now. Now all we have to do is sit here and wait until the option expires. Let's move on to SPWR. And this one, the stock has been declining, and well, this has been problematic. But what I do then is, as soon as the stock has declined enough so that I can say that my option extrinsic value is 0, I can roll down. And I keep doing that. The worst that could happen is that the stock declines to 0 too quick for me to adjust. But if I keep adjusting, the stock at some point will go up and then down. Hopefully it won't get to 0 before I recover my money with the extrinsic value. So let's go 1060, a credit of 79, so I subtract 0.79 and subtract 0.45. So my new value is $9.36. Look at the original, was $10.60. That means we have a scalpel, some money out of it. We have recovered a little over $1, even though the stock has dropped significantly. Okay, so at least we have recovered some of it. Still, we are not anywhere near recovering our money. So we just sit here and wait. So analyze closing, cover stock, and I'm going to analyze the opposite. Okay, that's my current trade right here, and I just adjust the price. Instead of $7.13, it's $9.36. So yeah, okay, so not too good, but at least we haven't lost all the money just yet. Okay, so we keep adjusting that in order to recover some of our money. So here, do I want to adjust? Well, the difference is about $90, and it would be nice if the stock jumped to $9 or $8.50, and we recover a whole lot more. So we just sit here tight and wait until this move closer to 0, and then, or you can say, well, let's see. What is the value of that option? Oh, point is 9 cents. Okay, times 100, so it is $100 really. You can see that. So I'm gonna wait until one more week. We have until September the 8th, and hopefully the stock will bounce at some point. It hasn't been doing very well. It's been declining. So, okay, one bad trade. Okay. Overall, we're still doing very well. So let's go to WDC, go to the Analyze tab, and hide the position, hide the simulations. We see the position here. Okay, in this case, again, September the 8th, and we have the difference between those two bars is still $150. So we just don't need to change anything. And if the stock recovers, well, we can still make good money. So we just sit here and wait for that to happen. Yeah, it could reverse here. It's come to the Ichimoku cloud. I think there could be a bounce there. So let's move on to X. Oh, this one jumped very significantly. Let's go to the Analyze tab. Okay, I'm going to do the same calculation. Let's go to the evaluation here. Okay. Say the calculator again. We started with paying $19.69, then a debit, obviously because of a roll up. So we need to add to my cost $2.60, and then a credit, we subtract 95 cents. So minus 0.95. This is my current cost, is $20.89. Okay, so let's analyze this. So we analyze closing. Show all. Okay, here it is actually. And just put it here, command paste, and that's my original price. After all the adjustments, I had the position, and you can see that this stock has gone up so much. For a completely different reason, the pink line is approaching the blue line. And what is the difference? Well, the difference is a little less than $100. So I'm going to leave it there as well. There's plenty of time for that to happen. What if the stock went down to here? Well, then I wouldn't. It would be better actually, because then you match the option. The new option would have more extrinsic value without us having to bring more money in. So let's sit tight and let that happen. Okay, so nothing else to do. I do have a trade that I would like you to consider. Let's go to the chart and enter mRNA. That's Moderna. Okay, this stock has, look at the volatility. Okay, it's at the bottom of their range here, and the volatility is probably going up from here. Looks really good. They had actually good news lately. Despite the fact that they have been underperforming, they actually lost money, and the volatility is quite high. So yeah, I'm gonna bet that this stock is about to reverse. Okay, I might be wrong, but it doesn't matter. It could stay where it is for 3 months, 4 months, 5 months, and we will recover our money. And the stock is trading at $100. So let's go to the Analyze tab and select an option that I want to sell. Again, with 30 days to expiration, we can do the 28. Let's click here on the bid of the option that has 0 intrinsic value. We would get $4. Click on the bid, and that means I will get $400 out of that. And I already told you, with a value of $100 a share, we want to get 500. So let's try then the September 35 days to expiration. Come over here, there, 600. So that's a lot better. If you click here, just $5 more, and it gets to where I need to be, 500 or more in this case. Okay, I think I want to do that. So let's go to Add Simulated Trades, select the same option, and just right click and say Buy Cover Stock. And how much am I going to spend? Well, it's 100 shares, so multiply times 100, and my cost is not going to be $105, it's going to be $95. Okay, so I like that. So create duplicate order, and you can see the price here, confirm and send, and it's going to cost me $9,569. And can I afford it? Well, no, turns out I don't have enough liquid value. Okay, I only have 7,855. So no, I can't do it. So we're going to leave it out. But this is, I just wanted to propose this. What about the other, the margin account? Could we do that? Yes, in the margin account we could do it. Okay, but I want to keep those matched. So this is just to show a good trade. I'm not going to change it. We have the same options in both accounts, and as you can see, they're both doing well. Let's say the margin account, so far year to date we have $7,000, okay, and that out of a 50,000 account value. Okay, so far so good. All right, I'm gonna leave it there. Thank you very much for joining me, and see you next time. Bye bye.